Mike Wilson, your Ellen Zentner has a negative 215,000 statistics for the jobs report. Maybe it's a one-off, maybe it's not. Fold in this American economy into your caution. You walk away from the bull case.
Yeah, look, I mean, I think that the bull case was always that Goldilocks would persist into, this year. And that was not our view. Our base case was that Goldilocks would be challenged. And of course, the bear case is that you slide into something even worse than that. And I would say, because we talked in this program last time, we were leaning more towards the bear than the bull. So what's going on? I mean, as you mentioned, we now have a negative forecast for non-farm payrolls tomorrow. The question is it just an Omicron, kind of final pareback and hiring, or is it something bigger? We've had this narrative of fire and ice, and we think it's going to be icier. That doesn't mean recession. It doesn't mean negative payroll numbers for the next 5 months. But, the idea that we're not going to have some payback here from what was a spectacular, kind of rebound during the pandemic, we think is naive. And you guys were talking about something I think that's really being overlooked, which is this bifurcation between the lower income cohorts and the upper income cohorts. Without the government transfers and with this inflationary burden, I mean, they are the ones bearing it. And it's going to slow demand. So I'm probably a bit more cautious on consumption in the first half of this year than my colleagues and also my peers around the street.
Mike, you and the team believe that fears over growth will overtake fears over interest rate hikes. And I wonder how that separates you from the rest of the street when it just comes to sector allocation beneath the surface of the S&P at the moment.
So, I think most people would argue that, if we're going to have a slowdown, then you want to go right back into the, high multiple growth stocks. And the problem with that analysis, in my view, or that conclusion, is that a lot of the growth stocks are also going to see a payback in demand. I don't want to pick on one sector. I think it's pervasive across a lot of different sectors. But let's just take technology as an example. Technology is inherently a cyclical industry. I'm pretty old. I've followed the industry for a long time. And I remember when it was treated as such. And for whatever reason now, I think people view technology as being, that it's non-discretionary spending. It's not. And if, we see companies start to struggle with margins, there's going to be a pareback in spending and also a payback in spending from the overconsumption there too. So I think the strategy that we're employing right now is high quality, but with a more defensive bias than a growth bias, because the defensive stocks, the stability of earnings is going to be more protected. And they're expensive too, but they're not as expensive as some of the growth stocks still.
Mike, how far have we gotten to your bear case, given some of the pitfalls that we've seen, the lack of a safety net behind the likes of Facebook, and now the sort of commensurate losses that we're seeing in PayPal and also Spotify?
Yeah, I mean, okay, so let's get into it. I mean, the fire scenario, I think everybody's on board with that. In fact, people are probably paying attention too much to that. The bond market's priced for a lot of tightening, and the equity market is somewhat priced for that. I don't think that's the main issue. It's now the slowdown. And as I like to say, there's a little bit of Peloton in everyone, okay? There's a little bit of Netflix in everyone. There's a little bit of PayPal in everyone, right? And now maybe there's a little bit of Facebook in everyone. So it's just broadening out. So I think if you would ask folks a month or two ago, Peloton was a one-off. They were a COVID beneficiary. But the reality is that a lot of businesses benefited from this sort of pull forward during COVID and the stimulus. So this is what we got to get through now, this sort of reset on expectations for growth. And so our base case for the year end is 4,400. Okay. Not very exciting. Our bear case is 3,900. But remember, you got to overshoot to the downside. So even in our base case, we're going to probably trade sub 4,000. Pretty easily sometime in the first half of this year. And we probably get, more bullish on the index.
John, a surveillance question here, John. He's killing me. Mike Wilson needs to understand there's no Peloton in me.
I was wondering whether there was some Peloton in you, Tom.
I don't know what Mike's thinking. There's
Thank you for the confirmation.
Thank you. Continue with the bear case.
Mike, it takes me to my final question. In conversations like these with you in the coming 12 months, will we be talking more about single names with you, away from just year-end price targets on the S&P? Is that where the business is going at the moment for you, Mike?
Well, we've been doing that. As you know, John, we do have a focus list of 10 stocks, and it's performed pretty well. It has a macro overlay to it. And right now, that list is very defensively oriented. It's overweight REITs. It's overweight some of the services areas. It's underweight, consumer discretionary. There's nothing in there in consumer discretionary. So we absolutely think that this is the year of the stock picker. That's the title of our outlook back in November. that doesn't mean it's easy, okay? Because when the tailwinds are gone, picking stocks is harder. So that's a challenge, I think, for portfolio managers this year, but they have to do it. It's going to be idiosyncratic. You got to find the ones who don't have the payback in demand, don't have the overvaluation. Those are two variables to focus on, and you go from there.